Gold price continues to soar, folks. It's up a blistering 42% year to date. But let's be real, that number is already feeling a bit conservative as we stare down the barrel of even bigger moves. Analysts at Goldman Sachs are casually tossing around the $5,000 per ounce mark like it's just another Tuesday prediction. And honestly, with the way things are stacking up, that doesn't sound half bad. In fact, gold isn't just playing in the big leagues this year. It could very well snag the crown as the best performing asset class of 2025, leaving tech stocks, Bitcoin, and even those flashy AI plays in the rearview mirror. We're talking about a metal that's been around since pharaohs were stacking it in pyramids, suddenly outshining the digital darlings of Wall Street. Today, we're diving deep into why gold's on fire, what could push it to those moonshot levels, the central banks gobbling it up like it's going out of style, and even a spotlight on a ground floor opportunity in U.S. gold mining that's got Alaska's heavy hitters buzzing. If you're not paying attention now, you might regret it when the next leg up hits. Let's get into it. Grab your coffee because this is going to be a ride. Thank you so much for watching, and I do sincerely appreciate every single one of you tuning in. Whether you're a seasoned trader, a longtime stacker, or just someone who's noticed that yellow metal commercial on TV and wondered, is now the time? Hit that like button if you're feeling the gold fever, subscribe for more breakdowns like this, and drop a comment below. Where do you see gold heading by year's end? $4,000? $5,000? Or are you betting on a pullback? All right, let's jump straight into the charts. Here we are looking at gold futures on this crisp September 29th, 2025, trading at a scorching $3,816.38 per ounce, up 1.27% from yesterday alone. That's not a typo. We're talking over $3,800, and it's been hovering in this elite territory all month. Year to date, that's a 44.8% surge. Yes, I said 44.8% because the momentum hasn't slowed since that early year dip. The high for 2025? A blistering $3,814 just last week. So we're dancing right on the edge of all-time highs, teasing us with what feels like the calm before an even wilder storm. You could say gold is doing pretty well. Understatement of the century. This isn't some flash-in-the-pan rally, it's a structural shift, the kind that rewrites portfolios and makes early birds millionaires. Speaking of gold's all-time high, let's talk about something that's got the Xverse, formerly Twitter, absolutely lit up. Earlier this month, Barchart dropped a post that stopped scrolls dead. Gold has finally taken out its 45-year inflation-adjusted record high. Congrats, everyone. We did it. Not only is gold smashing nominal records left and right, but when you adjust for inflation using today's CPI metrics, it's venturing into uncharted territory, places it hasn't touched since the disco era. We're talking about breaking through that 1980 peak of $850 per ounce, which, adjusted for modern inflation, sits around $2,780 to $3,000 in today's dollars. Posts on X are exploding with celebrations and caveats. One user quipped, "Gold just hit its inflation-adjusted ATH since January 1980. Real rates dropping, plus weak dollar fuel the rally," linking to a TradingView chart that's racked up thousands of views. Another from Gold Silver HQ broke it down brutally honest. Gold is now only 3.3 times away from real inflation, M2, adjusted all-time high. That's M2 money supply inflation, folks. The shadow lurking behind official numbers that makes you question if your paycheck's keeping up. But here's where it gets really spicy. What if we dust off the old 1980 CPI formula, the one that didn't have all the hedonic adjustments and substitutions that modern metrics love to play with? Enter shadow stats, the contrarian's best friend, cranking out alternate inflation charts that paint a far grimmer picture. Using that methodology, the 1980 gold peak adjusts to a whopping $9,300 per ounce today. Let that marinate. We're nowhere near that number, sitting at $3,816 like a sprinter who's just warmed up for the marathon. X users are all over this. One post from In Gold We Trust noted, "Even though the CPI-adjusted gold price has surpassed the 1980 peak, the underestimation of this official statistic has misled us all." Another from Stewardship Finance Academy tied it personal. Gold just hit an all-time high, inflation adjusted, proving it's still a great inflation hedge. My wedding gold has risen 2.5 times in value since then. So, what does gold have to do to bridge that gap to $9,300? Buckle up because the drivers are already in motion, and they're not subtle. One of the main engines roaring under this rally? Central bank gold buying, the quiet giants hoarding bars like dragons in a fantasy novel. Pull up this chart, and it's a 15-year love affair. Net purchasers every single year, and they're accelerating, not breaking. The World Gold Council's Central Bank Gold Reserve Survey 2025, dropped back in June, is a gold bug's dream report. Conducted from February to May with responses from over 70 central banks, it revealed something explosive. 95% of respondents, overwhelmingly, believe global central bank gold reserves will increase over the next 12 months. That's up from previous years, with 76% expecting gold to hold a moderately or significantly higher share of total reserves 5 years out, jumping from 69% last year. Why? Diversification from the dollar's wobbles, geopolitical chess games, and that nagging sense that fiat's on borrowed time. Goldman Sachs is all in on this trend, forecasting central banks will keep snapping up gold for at least 3 more years. They zero in on the biggest buyer, China, which has been averaging 40 tons per month, steady as a heartbeat. If Beijing targets a 20% gold allocation in its reserves, up from the current approximately 5%, it'd take about 3 years at that pace to get there. But here's the kicker. 20% might be playing small. Bank of America crunched the numbers and argues that central bank portfolios hit peak efficiency, that sweet spot of risk-adjusted returns, when gold clocks in at around 30% of reserves. Right now, the global average is a measly 11%. Look at this chart from BOFA. It plots efficiency curves based on gold weightings, and bam, 30% is the summit, where volatility dips and returns peak. Poland just upped their target to 30% earlier this year, and whispers from other emerging markets suggest they're eyeing the same. If China and crew chase that 30% level, we're talking hundreds of tons more per year, sucking supply dry and catapulting prices. Add in the Basel III rules kicking in fully by July 2025, classifying gold as a Tier 1 high-quality liquid asset, and suddenly banks worldwide have every incentive to load up. Central banks aren't just buying, they're reshaping the market. So, with all this firepower, how high does gold need to climb to claim the throne as 2025's top asset? Spoiler: not as high as you might think from these levels. In a fresh note dropped on Monday, Deutsche Bank analysts hiked their forecast, predicting gold could blast above $4,000 by the end of 2025, implying a full-year return north of 50%. That's from today's $3,816 perch. We're already 95% of the way there. To put it in perspective, the S&P 500's up about 22% YTD, Nasdaq scraping 16.8%, and even Bitcoin's only at 35%. Gold's lapping the field. But if we hit that $4,000 mark, game over, best performer, hands down, and that's conservative. Goldman Sachs, in a blockbuster release this week, laid out scenarios where gold punches to nearly $5,000 per ounce. Their baseline? $3,700 by year-end, $4,000 by mid-2026, fueled by relentless central bank demand and a softer dollar. But the upside case? If just 1% of the privately owned U.S. Treasury market, think trillions in bonds, rotates into gold amid Fed policy jitters or Trump's tariff tsunamis, boom, $5,000. That's a 31% jump from here, and it doesn't even factor in the central bank frenzy. Goldman warns that if Trump's meddling erodes Fed independence, investors could flee treasuries en masse, turbocharging the shift. Who knows how high it goes if that 1% turns into 2% or 3%? We're clearly in a bull market, and the tape doesn't lie. Take a look at the miners. They're the high-octane side of this story, amplifying gold's glow. The GDX, Vanex Gold Miners ETF, is up a stout 111% year-to-date, riding the ore wave like a pro surfer. But zoom in on the juniors with GDXJ, 125% YTD as of late September, outpacing the seniors because smaller explorers have more leverage to price spikes. And hold on to your hats for the big kahuna. GDXU, the microsector's gold miners 3x leveraged ETN, has rocketed 600.88% this year alone. That's not a misprint, over 600%, turning every dip into a launch pad. Compare that to the Nasdaq's measly 16.8%, or the S&P's steady but sure 22%, and you see why gold's ecosystem is the place to be in 2025. Miners aren't just participating, they're dominating, and with gold's momentum, expect more fireworks. Because of this massive bull run in precious metals, I want to profile a gold-copper exploration and development opportunity that's firmly on U.S. soil. One that's perfectly timed for the Trump era's mining renaissance. They're the sponsor of today's video, and trust me, this one's got legs. U.S. Gold Mining Incorporated, ticker symbol USGO on the Nasdaq. Alaska's been a cornerstone for Trump's administration from day one. Remember, the governor even swung by their flagship project. Whistler isn't just any deposit. It's the closest large, undeveloped gold-copper play to Anchorage, Alaska's beating heart, sitting just 105 miles northwest. Flashback to Trump's first term. On Inauguration Day, he inked Executive Order 13,783, unleashing Alaska's extraordinary resource potential. Boom, day one priority. Then came the follow-up, directing agencies to fast-track domestic mineral production, spotlighting copper and gold as critical for everything from EVs to national security. Fast forward to 2025, and the stars are aligning brighter. Alaska Governor Mike Dunleavy, a mining evangelist, isn't just talking growth. He's delivering, personally touring the Whistler site, and championing infrastructure to juice economic engines. U.S. Senator Lisa Murkowski's been in the mix too, visiting in recent years to underscore federal backing. And get this, just last month, in July 2025, Gold Mining Inc., USGO's parent, highlighted the state's ironclad commitment to critical infrastructure, paving the way for roads linking Whistler directly to Anchorage. That's not hype. That's highways to riches. USGO went public in April 2023 at $10 a share, with gold lounging under $2,000 an ounce. Today, gold's over $3,800, and the Whistler mineral resource estimate is a beast, 294 million tons at 0.68 grams per ton, gold equivalent, churning out 6.48 million ounces indicated, plus 198 million tons at 0.65 grams per ton for another 4.16 million inferred ounces. That's over 10 million ounces of gold equivalent potential, screaming value in this price environment. Dive into their latest 10K and the technical report summary for the full scoop. It's public, transparent, and loaded with upside. What makes USGO stand out? The ownership structure is chef's kiss unique. 78% of outstanding shares locked up by the parent company, plus another 4.5% in management and insiders, over 82% tightly held. This isn't your dilute-yourself-to-death explorer. It's aligned interest, skin in the game, the kind of setup that screams long-term execution over pump-and-dump nonsense. I love seeing that. It's the foundation for real wealth creation. Now, the catalysts? They're firing on all cylinders. First, the historic Fed rate-cutting cycle is underway. 25 basis points in September, more to come, slashing gold's opportunity cost and igniting the safe haven bid. Second, gold at all-time highs means every ounce in the ground is worth more, juicing valuations across the board. Third, Trump's back and Alaska's on the menu. Those executive orders aren't relics, they're blueprints, with the state fast-tracking a road system to connect Whistler to markets. Fourth, And this is huge. USGO just kicked off their Preliminary Economic Assessment, or PEA, the gateway study that pencils out viability. With gold north of $3,700 and copper at $4.50 a pound, the timing's poetic. Oh, and fresh off the press. September 22nd, 2025. Metallurgical tests boosted gold recovery to 85%, a 22% improvement, unlocking even more from the ore body. Plus, they're advancing a 2025 exploration program, drilling new targets at Whistler Orbit and Muddy Creek to grow the district-scale footprint. They even appointed a mining veteran to the team in early September. This isn't hype, it's momentum. Do your own due diligence on U.S. gold mining, ticker USGO on the NASDAQ. Crack open their annual report, scour the SEC filings, and talk to your advisor. This is opportunity knocking in a bull market. With central banks piling in, forecasts soaring, and policy tailwinds, plays like this could be the leveraged bet that pays off big. Gold's been doing very well lately, hasn't it? From those sleepy sub-$2,000 days to this $3,800 rocket ship, it's a reminder that sometimes the old guards outperform the new kids. I'm curious, where do you think it's headed from here? $4,500 by Christmas? $5,000 in 2026? Or do you see a breather first? Let me know down below in the comments. I read everyone and love the debate. If this breakdown fired you up, smash that like, share with a friend who's still in bonds, and subscribe for the next deep dive. Maybe silver's turn next?